right, we want to continue our discussion about calculating business income. Share my slides with you, or sorry, share my screen with you. And I want to start by looking at the Income Tax Act in detail. I'm going to use my actual act here because it's a little easier to maneuver in terms of what I want to do at the beginning. So we mentioned that we start this subdivision B, income or loss, business or property. And again, remember all these rules apply to property income as well. So I won't repeat this when we get to the property income section, but you want to make sure you're clear that we distinguish the two sources. So we have income subject to this part. Taxpayers' income is the profit from that business. So you see that profit there. So we've talked about that's an accounting concept that we'll be using. But the other sections you want to then pay attention to are section 12. So you've got section 9. I go to section 12. This is income inclusions. And look at these in detail. Then you'll go to section 18. I'll move this up. Deductions, general limitations. Then you'll go to section, well, we'll look at section 19. I want to talk to you about that, but you'll go to section 20. And these are deductions. Let's get it settled. There we go. Deductions permitted. So what we have is section 9 says here's the profit, that it's the profit therefrom. Section 12 says here's some specific information on what's included, because profit's just a very broad, not defined term. Then you have section 18, which is your general limitations on deductions. We'll look at that. It's what we expect. There's no deduction unless you can find a way in. And then section 20, which actually gives some specifics on deductions that are allowed. So I want us to just kind of briefly go through some of these. First, I want you to look at section 10. Section 10 comes along, valuation of inventory. Now, as it happens under the law, if you read through this, for tax purposes, the client is required to use lower of cost or market inventory. So it's just one of the things that we won't go into detail on how to do that, but I'm assuming that you know how to do a lower of cost or market inventory for accounting purposes, and that's the same thing you'll do for tax purposes. I want to point out as we go along, we have section 11. This is if we have an unincorporated business, and it talks about the tax year. So this relates to the proprietor of an unincorporated business and having the business income included in his tax return in the fiscal period that the business ends, the year that that business ends. So then we look at section 12. So this is specific details of what is included, section 9 notwithstanding. So there shall be included an income of the taxpayer as income from business, such of the following amounts as are applicable. And then it's just a very long list. But I want you to notice, so services to be rendered. That is if you've received the money, but you haven't rendered the service yet, you still have income. So an amount received by the taxpayer for services not rendered. Now you might say, well, wait a minute, what about a reserve? Well, that comes later. So we have the services to be rendered. There's your accrual accounting, right? So that's an amount received that we've all, sorry, cash accounting. Here's an amount received. Cash accounting says you received it, you pay tax on it. Then we have 12(1)(b), all right, amounts receivable. So basically 12(1)(a) and 12(1)(b) say either you got it or you're owed it, and either way we're going to tax it. And they do fix that. It's not a problem. We see that interest is included. We see reserve for doubtful debts included. We're going to talk about how that works, because what they're saying is we include last year's reserve, we deduct this year's reserve under section 20. And I don't think there's anything, recovered bad debts, things of that nature. There's nothing specific I want to look at in addition with these. But what I do want to suggest is that you basically just read through it and look at the different things that are mentioned so that you have some comfort with it and some idea of what sorts of things are talked about. You'll see these in the problems, and the stuff that really matters will show up in the problems. Now, we want to go back. Section 18 now is our deductions. So we have general limitations in computing the income. Just try to make sure you can see it. No deduction shall be made. Again, you'll recall we said in the tax theory lecture, when in doubt about deductions, you don't get them, they reduce government revenue and so forth. So you have to find a very specific place that allows you to get the deduction. And here's where it says no deduction. So no deduction respect of your activity unless, all right. So no deduction, general limitation, and outlay expense except to the extent made or occurred producing income from business or property, which is what we've seen before and what we're just, kind of like, oh, well. But notice if you go through your act at this point, you find a whole bunch of pages, not a whole bunch of pages, but a whole bunch of verbiage in terms of some of the developments in the area. It's a not as straightforward as some people might think. Then we see 18.1b. I want to point this out. There is no deduction for a capital outlay or loss. Now, what we're talking about here is when you buy equipment, there's no deduction. Now, again, you might say, well, but wait a minute, what about depreciation? Well, again, get used to how the law works. There's generally no deduction. We find elsewhere, as it happens in section 20 and then refers us to the regs and so forth, there is a deduction, but the starting point is no deduction. And then you have to fit within the provisions in the regulations and other places to get what amounts to tax depreciation. We'll talk about that when we do, quote, CCA. Outlay or expense to the extent it's incurred for the purpose of gaining or producing exempt income. What we're saying here is if the income is not taxed, they're not going to give you deduction. It's logically, if I'm not going to tax the income, I won't give you a deduction. So again, you can go through this section. Another one, personal living expenses. If the cost is personal, they're not going to give you deduction. They say other than travel while away from home in the course of the business, well, that's not personal, right? So it's really somewhat redundant. They've already said you don't get a deduction for personal. Well, if it's for business, that's not a personal thing, right? So you see things of that nature, right? So these are just, again, a lot of different provisions. This applies for definitional purposes for other things. So you go through section 18 and you see all the different amounts not deductible, right, as you would expect. Now, I want you to see section 19 just briefly, mainly because I find it entertaining, where section 19 says, let me back up, see if I can get it more clear for you. No, that's less clear. There we go. Section 19 says limitation on advertising expense. No deduction made in respect to something that would normally be deductible for advertising in an issue of a newspaper that is aimed at a market in Canada. So they're saying, all right, if you're advertising in an issue of a newspaper and the market you're targeting with the ad is Canadian, then that better be a Canadian newspaper. What they're talking about is if you're advertising in a Buffalo newspaper. So if a Canadian company, say a St. Catharines business, advertises in the Buffalo News, targeting a Canadian, like people in St. Catharines, like maybe it's a restaurant we want you to eat in St. Catharines, that's not deductible. All right. And what happened here, I partially bring this up because this was in response to a provision the United States put in that was basically the equivalent, and Canada was like, well, hold on, if you're going to do it, we're going to do it too. All right, so then what we get to is section 20. Now, so we saw section 18 saying nothing's deductible. Now we're seeing section 20, and section 20 is a list of deductions that are permitted in computing income. And this is where you see, notice, the capital cost of property gets picked up, but only as allowed by regulation. So what they've done, similar to Section 61A, when they said it's not included as a benefit, and then somewhere else said, yes, it is, but you have to do it my way, the standby charge, for example. So again, this is what's happened with capital property. They're going to define how to do tax depreciation, and as a result, they've said first it's not deductible, then okay, it is, provided you do it our way. Expenses of incorporation, normally these would be capital and amortized. We have a $3,000 amount that we can deduct during the year. Whole lot of rules about interest deduction. These are important to be aware of. And it has to be borrowed money used for earning income from business or property. Now, I would note here, notice it doesn't say anything. So we're allowed to deduct an amount paid in computing income to a legal obligation to pay interest on borrowed money used for the purpose of earning income. Now, it doesn't say anything about the security. So think about, for example, if you own your home and you go borrow money using your home as security on the debt, and you invest that money, that interest will be deductible. Even though it's mortgage interest, you didn't use the money to buy the house, you used the money to buy investment assets. We'll talk about this again. Income, but it's a classic tax planning thing where you tell your clients, pay off the mortgage, then you can borrow and invest, and that typically is a positive thing to do. Let's see, then I want you to say, okay, reserves, I just want you to be aware of the system for reserves. Here we have your 21L, 20 sub 1L. This is where you'll have your doubtful debts. Remember, we said we're including amounts received. We're including amounts receivable. If it's receivable, here's your allowance for doubtful accounts, permission to do it. This has to be done in an aging. So you need to be aware this is an aging technique, and we'll look at I'm assuming again that you know how to account for bad debts and that you can either do percent of sales or aging. Most companies use percent of sales. It gives a better matching process to income because you're looking at an income number, sales, to get an income number, bad debt expense. The tax law requires an aging, which is a balance sheet comparison. You're looking at balance sheet information, the accounts receivable, determining how much is uncollectible, which means you're determining the allowance for doubtful accounts at the end, and the net will be your bad debt expense. So typically we always add back accounting bad debt expense, add back the beginning reserve. That's how the law says to do it. And then we subtract the ending reserve. I'll do this in a follow-up lecture. We also see the reserve. Here's your reserve for that account where we did the cash basis, that we included income amounts received, but if the goods and services not delivered, here's the reserve for that. But I want you to be very careful with these reserves. Generally speaking, reserves are not deductible. There are very few reserves allowed. And notice, for example, even when you see, so this says manufacturer's warranty reserve, and it says where an amount has been included in income and we have a reserve in respective goods where we basically expect that we may have a extended warranty payment due because we have experience with this. Data analytics again tells us how much and so forth. That's deductible, but only, notice, not exceeding. Don't stop reading. Oh, we get to deduct a manufacturer's warranty reserve. You didn't read far enough. You got to keep going. Not exceeding the portion of the amount paid to an insurer that carries on insurance business in Canada. So if the company funds the warranty reserves itself out of its regular earnings, that reserve is not deductible. That has to be added back to income. It's only deductible if it's an amount paid to an insurance company. And that's basically the premium is what is deductible, not the reserve itself. All right, so you got to be careful with some of these things. And 20, I wanted to just point out 20 sub 12. Here's a deduction for a foreign non-business income tax. We'll talk at some of you will talk about the foreign tax credit. And this is one of the places where you could deduct it instead of taking a credit. Rarely a good idea, but it is available. So again, familiarize yourself with Section 20. Now, so that gives us, we have Section 9, Section 12, Section 18, Section 20. But there's some other rules we want to look at. Subdivision F in Part 1, Division B, rules relating to computation of income. The first one, any deduction has to be reasonable. We talked about this in a previous lecture. It has to be reasonable. Meals and entertainment, amounts paid for food or beverages or enjoyment of entertainment is deemed to be 50% of the lesser of the amount actually paid or the reasonable amount. So you first look which is lower, the reasonable or the amount paid. So if it's excessive, you only get the reasonable amount. And then it's only 50% deductible. And it doesn't actually say it's only 50% deductible. It says we're going to pretend you only paid half of what you actually paid. Okay. Now, there are some exceptions to the 50% rule. So you need to pay attention to those. If your business is providing food and beverages, you get to deduct all your expenses for your business. If you've got a charity fundraiser, they'll let you deduct them. If the amount you're expending is included in an employee's income under Section 6, so if the employee benefit is 100%, the company can deduct 100%. What we're saying here is that's equivalent of salary. And a final one that you might want to take notice of is the company is allowed to have 6 or fewer special events like Christmas parties, summer parties, a baseball trip or something of that nature to benefit the employees. We see that there are rules on the limits for money borrowed for certain types of vehicles. This will relate to something we talk about in the CCA lecture about luxury cars. There are limits on the deductible amounts if we're leasing a passenger vehicle. Again, it's similar to limits we'll see with company cars. And notice we've got limits on deductibility of illegal payments and deductibility of fines and penalties. I mean, people manage to argue that, okay, the big truckers, that the speeding tickets they would get were simply a cost of doing business. So they were deducting them. And that means essentially you and I were paying half the speeding ticket for the truckers, things of that nature. So the government has said, wait a minute, no. So payments, fines and penalties imposed by any kind of political organization are not deductible for tax purposes. So I'm going to stop there. I'll stop sharing my screen. And again, you can get your assignments out. You can look at them. I'm going to do one more lecture where I talk about some odds and ends of things and show you how to do the bad debt reserve, make sure that we're clear about that and things of that nature.